So the Federal Reserve at the time of this recording has had its June meeting and stuck to its guns at the pause that they indicated and gave vibes that they would give from the last FOMC meeting that they had. The Federal Reserve also indicated directly that they are going to likely stick to 2 more rate hikes that they can foresee throughout the rest of 2023 at least, with indicators also stating that by July, it could be a live meeting, meaning that we could see another rate hike as soon as July. With that being the case, the big thing that you need to focus on is where your money needs to be now that we see the Federal Reserve is definitely sticking to its guns and keeping rates as high as it feels it needs to get inflation under control before a recession kicks in. If you follow my channel, you already know I made it abundantly clear. The Federal Reserve is terrified of inflation still being high with an economic recession kicking in at the same time. That's exactly what they don't want to happen, and they will raise rates as high as they have to, as long as they have to avoid that from happening. With the Federal Reserve forecasting a potential recession as soon as December, then that means that the Federal Reserve is putting themselves on their own clock to get inflation under control before December. So if that's the case, what do you need to be doing with your cash? Let's make it abundantly clear. Unless you have a defined strategy that's already working, real estate, the stock market, and crypto are all extremely challenging places to be right now. Believe it or not, one of the most attractive places right now is deposit products, bank deposit products, money markets, and if you're in a retirement stage, annuities are also more attractive right now. We're gonna stick to deposit products in this video. What I wanna cover is what is the best option, bank level, FDIC insured deposit product that you need to be in so you can be getting the best return on your money and it fits your time horizon. That's what this video is mostly centered around. CDs or high yield savings account. Both of them are very attractive on their rates right now compared to other places you could be, given the fact that both options are risk-free. So the quick distinction between the two is high yield savings accounts are fundamentally just savings accounts with higher paying rates. It's liquid. That means that you can walk into the bank or virtually or by debit card or ATM card, get your money out at a moment's notice without having to get any permission, any consent. You're not locked into any contract. A CD is a certificate of deposit. This is basically like a savings account with a contract agreed upon term of keeping that money in a certain duration of time. So with that being the case, a little different. You're agreeing that you're going to leave that money there and the bank's going to usually pay you a better rate because you're given that peace of mind that that money is going to be there for it to stay, which allows the bank to make some moves that they may not normally be able to make with the savings account because they're not sure that money is going to be there tomorrow. High yield savings accounts are going to be the best fit for individuals who have a reasonable amount of cash. I really think this only makes sense if you have at least 4 or 5 figures or more. And a high yield savings account is going to be most attractive if you have either an undefined timeline for that money or you have a defined timeline, but it's relatively short. Now, you may want to consider a high yield savings account if you see a better rate on a high yield savings account and you're not really sure when you're going to need access to the money, or if you want to just continue to hunt for the best rates and move that money around. Now, a CD is going to be more attractive if you know that money doesn't need to be touched for an extended period of time. You're not the type to keep shopping rates every couple to few months. And caveat here is if you really want to lock in a great fixed rate for an extended period of time, the best CD rates right now at about 3 to 4 months term. 3 to 12 months terms. So that means the Federal Reserve is going to do its job to get inflation under control before the year is out is most likely their goal. That means rates quite possibly could come down as the economic recession kicks in later this year or early next year. The Fed could start slashing rates as early as fourth quarter this year or first or second quarter next year. If you lock in a high rate CD, 3.5%, 4.5%, 5% now for a 12-month term, that means while everything else is dropping, including high yield savings accounts, because that's the thing. Those are flexible for you to get your money out. So are the interest rates. The bank can change that at any point in time. With a CD, you're guaranteeing to leave that money in, but the bank's guaranteeing to give you that rate no matter what's going on. You can lock in at 3.5%, 4.5%, 5.5% during rate cuts when everything else is paying less in interest. And the investment markets may still be a little muddy of a place to be in that early phase of those rate cuts. So you can lock in a higher percentage, even with bank rates starting to come back down fourth quarter this year, first quarter next year, second quarter next year, if you can do a 9 to 12 month or 15 month CD at the most attractive rate. So I wanted to bring this to your attention so you have a better idea of where to put your money, how to place it, how to make that decision when you're deciding what do I do with my excess capital or cash until I decide to deploy it where I ultimately want it to be. If you want the best rates and you want liquidity or you're willing to shop, how your savings accounts may be more attractive. If you want to lock in really great rates and you want to lock it in potentially longer than they're going to be available, then a CD may be a better option for you. So we're going to keep monitoring this situation closely. To all my pioneers out there, thank you for tuning in. My new viewers, welcome in. Like, comment, subscribe. I want you to comment down below and let me know your familiarity with any of these products. Let me know what you're doing with your money and let me know where you think the Federal Reserve is headed next. Let's keep the conversation going down in the comment section. Other than that, I want y'all to stay focused, stay in motion. I'll see y'all soon. This is JP from Blueprint for Prosperity Network, a channel dedicated to helping you increase your net worth through relationship banking, maximizing your borrowing capacity, the proper use of life insurance, and the ownership of real estate. Like the video, subscribe to the channel. I'm uploading content on a daily basis to help you customize your blueprint for prosperity.